Switching out of expensive mutual funds and into a low-cost ETF portfolio is how I helped my client go from a $140,000 portfolio to almost $500,000 in 6 years. If you're in expensive mutual funds, I'm going to show you in this video in 6 steps how to turn your money-sucking mutual funds into a winning low-cost ETF portfolio, whether you're working with an advisor at a bank or if you manage your own investments. I've helped numerous clients rebuild their investment portfolios so they can hit their retirement goals faster and retire earlier. If this is something you want, go ahead and book a free investment strategy call with me and we can work on your next steps. Now, if all you know is you're in mutual funds with a financial institution, but not sure what it's costing you or if it's even expensive for that matter, then keep watching because I'm going to show you in this video how to look up your mutual funds, how to determine what your mutual funds are costing you, what to invest in instead, and how to go about doing it. The first step is to look up which mutual funds you're invested in. Now, you may be invested in more than one, and I'm going to give you an example of how to replicate one mutual fund. To look up your mutual fund, you're going to have to go to your mutual fund statement that you get each month. If you're with RBC and you have some rural mutual funds, your statement may look something like this. Now, this is just a portion, one section of the mutual fund statement. If you're with TD, you're going to see something like this, which is your activity for the month. Where you'll find the name of the mutual fund is here. Now, this is the Royal Bank Mutual Fund example. So the name of this is RBC Select Conservative Portfolio Series A. This is the mutual fund number. If you have TD mutual funds, these are the names of the funds for this one statement. So this is the TD Monthly Income Fund and then the TD Comfort Balanced Portfolio. These are the names of the mutual funds that you are going to be looking up. The second step is to copy and paste the name of the mutual fund in a Google search and then go to that website. So for example, if I'm going to look up the TD Comfort Balanced Portfolio, just going to copy and paste it here. And the first several results will show me the link to that balanced portfolio, that particular portfolio. So when you're doing a search for the mutual funds, make sure that the site that you click on is by the financial institution where you're purchasing the mutual funds from. So I'm going to go ahead and click on the first link. And it's going to show me a list of their mutual fund portfolios. So I'm going to be looking up the TD Comfort Balance portfolio. The third step is to look for the fee. This is the management expense ratio, MER for short. Any fund, any type of fund that you are interested in investing in, there is usually an MER attached to it. And this is the annual fee that you pay for the portfolio managers managing this fund. So in this case, it's 1.92% per year, and it's a percentage of your entire portfolio that you are paying to the banks each year. Whether it's a great year or really shitty year, you are paying this fee. So if you're paying almost 2% or more, that is very high. Okay, the average mutual fund fee is around 2.3% in Canada. This can cost you well over 6 figures, like well over $250,000 by the time you retire, because as your portfolio gets bigger over time, so does the cost of your mutual funds, because you're taking a percentage of your entire portfolio. So by the time you have a $300,000 portfolio, you could be paying over $6,000 per year in fees. Okay, that is a vacation every year. Whereas if you find an ETF that could be costing, that costs much less, let's just say 0.25%, that's $750 per year versus $6,000. Okay, huge difference. And you better believe it's going to add up to a lot of money over several decades. This is how I've helped one of my clients add over $380,000 to his retirement, just from switching out of expensive mutual funds and into low-cost ETFs. Once you look up your mutual fund and the MER fee, the fourth step is to build out your ETF portfolio based on the benchmark index. Now, you're going to find that right here under benchmark. So for every mutual fund that's out there, they're going to list out a benchmark. And that's basically what is being used to measure the mutual fund's performance. Okay, most mutual funds do not outperform the index right here once fees are factored in. So that means that this index is the one that usually wins and pretty much beats the performance of the mutual fund. So this is the portfolio that we want to build out. This is what we are basically using to replicate this mutual fund. What you want to do now is to list out what's included in the benchmark index and its respective allocations and just put it in a spreadsheet like this. Now, what this means is 55% of the mutual fund is invested in Canadian bonds. And so it's going to compare that portion, 55% of the mutual fund, to the FTSE Canada Universe Bond Index, which is just Canadian bonds. 13% of the mutual fund is being compared to the S&P TSX Composite Total Return Index, which is just the Canadian stock markets. And 32% of the mutual fund is invested in global stocks. So it's going to be compared against the MSCI World Index. Now, how do I know this? Well, the information is all included on the website down here. The sectors, the geography of the fund, and the specific funds. So this fund holds other funds and what it's invested in. Now, if you're not familiar with how to navigate and interpret what's on this website, that is okay. I will be discussing that in another video, but for now, a shortcut is to just copy and paste and look up what exactly this is. So the MSCI World Index, just a list of medium and large size companies across 23 developed countries. So all you really have to know is that 32% of that mutual fund is being compared to the MIC World Index because 32% of the mutual fund is being invested in global stocks. So putting all of that information here, making sure it adds up to 100%. So now I'm going to look for 3 ETFs. One ETF that's in Canadian bonds, one ETF that's in Canadian stocks, and one ETF that's in global stocks. So step 5 is to find the ETFs that are similar to the benchmark index. Now you're going to start with the same financial institution that's offering the mutual fund. For example, TD has a list of ETFs on their site, and they're sorted by stocks, which are equities. And then there's fixed income, which are bonds. So if I'm going to look for a Canadian bond fund, I'm just going to go through and see that there is a Canadian aggregate bond index ETF. And as you can see, the management fee for this one is 0.07%. And I'm just going to go ahead and enter that into the spreadsheet and enter in the MER. So I do that for each of these indices. And I found that there's a TD Canadian Equity Index ETF, because this one represents the Canadian stock markets. And then this one represents global developed equities. So I found a TD Active Global Equity Growth ETF. And once I've included all the MERs for each of these respective ETFs, did a quick calculation using the sum product formula. And based on this ETF portfolio that I have, which is similar, which is pretty much replicating this mutual fund, my new MER is now 0.25%, okay, versus 1.92%. Okay, so on a $300,000 portfolio, that is around $755 versus an annual cost of $5,760. Okay, huge difference. So on a side note, when we're talking about the fund's asset allocation, in this case, 55% of it is in bonds and 45% of it is in equities. Now, if you're wondering if having roughly 50% equities and 50% bonds are good, assessing this asset allocation is also another huge factor that could affect your future returns. This is where you must know your risk tolerance to make sure you're invested in an appropriate asset allocation, basically making sure you're taking enough risk. The more bonds that you have in your portfolio, the less growth you are going to be expecting. The more equities, the more stocks that you have in your portfolio, the higher the returns that you should be expecting to earn. And not taking enough risk is a risk in itself. So make sure that you are taking enough risk. Again, I always say this to everyone, you're putting your money to work anyways, you're not touching it. You might as well maximize the returns that you're going to be earning on your investments. I helped another client add $480,000 to her retirement by increasing her risk tolerance simply by just increasing the equities portion of her overall portfolio, because she was in super conservative, low risk investments, so a lot of bonds, on top of being in expensive mutual funds. She was paying over 2% per year. So just the fees alone would have added an additional $250,000 to retirement. That's a total of $730,000 she could have lost out on had she stayed in her expensive mutual funds and in low risk investments that were just not appropriate for her. So again, I call these two profit killers. You can check out this video where I talk more about how these can affect your investment profits and how you can calculate what it's costing your investments. So the sixth step is to tell your bank advisor, if you're working with one, that you no longer want to be invested in these mutual funds and that you rather be invested in ETFs. They should be able to pull up a list of ETFs that their bank offers and be able to put you in those funds instead. That means you're going to have to sell your mutual funds so that you can have the cash to purchase the new ETFs. Let them know which ETFs you want to purchase, or they should be able to help you build an ETF portfolio that's similar to the mutual funds that you are currently holding. If you manage your own mutual funds, make sure to check what the penalties are, if there are any, for selling your mutual funds and any tax implications. And that all depends on where these mutual funds are being held, whether it's a registered account like a TFSA or RSP, or in your non-registered account. If your mutual funds are a non-registered account, you're going to be subjected to taxes. So if you have any questions around that and you want to speak to me more thoroughly about this, go ahead and book a call with me for your free investment strategy. The link is below.